So when we talk about Broadcom, they're guiding what is 60% year-over-year growth in their AI sector, but their non-AI segments remain flat. So how should an investor weigh the sustainability of their AI-driven upside against the slower recovery in their legacy business? Or is it time for Broadcom to focus on its non-AI business to support their multiple expansion?
I think when we think about Broadcom here, the story will continue to be AI. And the thing is, AI will continue to be a bigger, piece of their revenue and their, specifically their semiconductor business. You alluded to the 60% plus growth rate in terms of the AI semi business. That's that 60% growth rate is something on the last earnings call that Hock Tan had alluded to, essentially being sustained through the end of calendar 2026 with a potential acceleration in the second half of next year that could take place. So when you think about how big their AI semi business is getting, it now exceeded half their semi business about a quarter or two ago. You continue to see at that run rate, it's going to be essentially the lion's share of that semiconductor revenue as we exit next year. I think that the biggest kind of thing that we've got to look for on this call, and something that has really driven the stock here over the last 5 to 6 quarters, is what type of customers, if any, are they adding to their AI ecosystem. We've seen them add a number of new a number of new companies to their kind of AI ecosystem here over the last couple of quarters, and a lot of those customers have yet to ramp. They're going to ramp here over the next 6 to 8 quarters. So again, we're going to see that 60% growth rate continue through the end of next year. You're going to see the Oracles, the OpenAIs, the Apples of the world all significantly ramp up their custom silicon business with Broadcom here over the next couple of quarters, and that's going to sustain the growth rate. As far as the non-AI business, we do expect to see some growth here over the next couple of quarters. They're kind of bumping along the bottom here. You've seen some of these other non-AI oriented businesses start to see some improvement in their businesses. So we do expect that to take place at Broadcom, but that's not the story. That's not going to drive multiple expansion. It's going to be the momentum and the potential new customers they add on the AI side.
They're still targeting 66% or above adjusted EBITDA margins. How credible is that guidance? Or could their problems in the EU regarding the VMware deal create, some incremental risk to the infrastructure software growth story?
Yeah, I mean, and it's interesting because when you actually look at their AI-oriented business too, right, it is coming at slightly lower corporate margins because gross margins, because that custom silicon business isn't generating as high margins as other aspects of their business. But the scale of that business is flowing through and helping the adjusted EBITDA number ultimately. So as far as being able to sustain the margins, we do think they'll be going to be able to sustain these margins or roughly around a fairly tight range here over the next couple of quarters. So we're not necessarily concerned about what's going on in terms of the EU or what have you, but ultimately, they'll continue to, we think, see double-digit growth as far as their VMware business is concerned. Of course, at a decelerating rate relative to what we've seen in the past. Whereas their semiconductor business, again, probably starts taking up a greater mix of their overall business. But when you start looking at the total dollars that they're generating on a combined basis, that adjusted EBITDA number should be fine, but there could be pressure on the gross margin itself.